I want to talk about a very easy setup that you can identify and be able to forecast future price movement in this lesson of price behavior. That's what you're learning here, price behavior. You're looking at a chart of the pound and Aussie cross pair, and you're looking at a 15-minute chart. Whenever you are watching my videos, you can identify the symbols on the left-hand side, top left-hand corner, okay, on my charting platform. Now we are looking at the current week that has passed. Now, the trade that I'm going to walk you through, I didn't trade this, okay? So it's not a trade that I took, but it's a very, very good lesson because it's a repeating pattern. So this line here, this blue vertical line, that denotes the start of the week, okay? What that means is this here is Monday, okay? That's Monday, Tuesday. So each one of these boxes or these lines represents a days of trading: Wednesday, Thursday, and Friday, okay? These days are important. That's why I'm mentioning these. So the first thing that I want you to notice here is that on the Monday, what we've traded here is important, okay? This break to the downside is important. That's what gets me interested into this market. And that breakdown is a move that is below the last week's low. Okay, so this is all last week. Okay, and you can see on Monday, let me actually see if I can write that in so that you can see the days there. So let me write it in here. So that there is Monday. Okay, so that's your reference point. Okay, so now you'll be able to identify all the different days from there. Okay, so Monday we take out the low of the previous week. That's important. It becomes important when you break out through that low. Okay, I've spoken about this many times. Now you've got short sellers in the market, short breakout traders in the market. And what I look for is a reversal. I like to trade reversals. That's my style of trading. So here you've got a breakout below the low of the week, and it's false because you get a pushback inside the weekly range and a pushback down, and then a continuation to the high. Okay, that's a false breakout reversal at the low of the current week or the low of the previous week. If you've taken out the low of the previous week, much more powerful. Okay, now something that I'll point out here is that's not a bad trade when you do that because it's low risk, okay? It's high probability when it reverses and creates a false break and you get a push back into where it broke out from, okay? That push back, so you get a false break, that pushback is actually to try and scare out anyone that may have longed and got into that market from the lows there. That's what it's designed to do. But the thing you need to look at is you need to have some kind of reason for this to move higher. What's the reason for this to move higher? If you look on the left-hand side, it's a double top, okay? We call this relative equal highs, okay? It's a very well-known term, not something I made up. But the market, this is where the manipulation comes in. The market is designed in that way. It's engineered to leave those highs like that. And the reason the market does that is because you've got people who have gone short from that level, okay? And when the market breaks a daily low, this dotted line right here on Friday, this is Friday's low, right? Because that's Monday, so that has to be Friday. Okay, so this day is Friday. Friday, these dotted lines are the low of the previous day. Okay, so on Friday, that there is the low of Thursday. Okay, Thursday being this day here. Okay, so people that are short from Thursday, right? So that's Monday. Okay, this is Thursday. Now this is Thursday. So people that are short on Thursday, on Friday when the market breaks the low of Thursday, what people tend to do is they put their stops above the high where they got in, okay? So the stops are there. Now, that's pretty much close to the stop over here. And now you've got this double top, okay? So people kind of think, retail traders expect that to be resistance, and they put their stops up there. And what they don't realize is the market's actually designed, it's engineered to leave those highs intact because the market has already predetermined to go through that, right? This move down is the manipulation to go higher. And in doing so, they want to take people's money who have stops up there. Okay, so that's why the market has engineered itself to leave that there. Okay, so if you do see, well, this is how I trade, right? Price behavior. Price behaves in a manner that if you learn it, then you can forecast future movement to some degree of probability of success. So when I see that a low of the week has been taken and it's a false break reversal, meaning we've come back inside the weekly range, I look to the left and I see, is there a reason for this market to move higher? And if I see something like this, well, then I know that that's going to be my first initial target. Okay, so let's actually put a little line there. That's going to be my first initial target. Okay, now remember, I didn't trade this market, pound Aussie. There were other trades that I did. I think I may have traded it in this week. I don't recall now, but the focus of today's lesson, the setup I'm going to walk you through today, which is not this one, is not one that I did, not one that I traded. Okay, so that's the reason now for the market to move up and go through that level. Okay, after it has taken out this weekly low, okay? And you got to understand, what has the market done? Why has it come down there? And it's come down there because there were people who bought on this day, this is a Tuesday, right? On this day, Wednesday, maybe people even bought up here on Thursday, right? Why would people buy here on Thursday? You got to understand the manipulation. Every move in the market is designed and has an objective, okay? Why would people buy here on a Thursday? Because people see this high over here, and the retail traders kind of want to buy here and go through there. Now look at how, and what they do, they have their targets above this level because they see on the left that that is a potential high that they want the market to go through, okay? And so retail traders are buying this with the expectation that they're going to go through that high on the left. Notice how the market doesn't take out that high, right? But even on that day, why is the market coming up there? Because there are short sellers in the market from the day before who would have their stops above that high. Remember what I said, when you have short sellers in the market, they will put their stops up high above where they got in when the market goes down a previous day low, okay? So now on Wednesday, the market goes down and you've got short sellers in the market, okay? And the market's gone down a previous day low, okay? At that point in time, the retail traders put their stops above the high, okay? And notice then on Thursday, the market goes up there, takes out their stops. Whenever the market is going to go a particular direction, meaning that on Friday it's going down, it needs to have a false move before that. It needs to take stops from retail traders to fund the move in the opposite direction. What does that mean? Well, think about the trader who's short on Wednesday. I know that's Wednesday because remember this vertical blue line, this start of the week. So this here is Monday, this is Tuesday, this is therefore Wednesday, okay? And so people who are short, as I said, their stops are above that high and they place those stops typically when the market goes below previous day low. So on Wednesday, the market went below Tuesday's low. Now anyone that's short from this level has their stops up here. On Thursday, the market goes up here because the market makers want to go down on Friday. So what they need is they need to take out the stops up here, right? Which they do. And they are buy stops, right? So if I'm short from here to protect my capital in case the market rips higher, I put into the market a buy stop above that level, okay? And that's what the market makers want. They want people who are willing to sell them this pair at a high, right? So the market is moving up there to take those stops to fund, right, their move lower. They want to buy from willing sellers at a high, okay? So the market has moved up, stopped out anyone that's short from this level, left this intact, okay, because they are planning a bigger move later on, okay? So why then, after doing that, is the market on Friday coming down? Because they want to stop out anyone that is long from Wednesday, okay? They want to stop out anyone that's long on Wednesday. Okay, so that's typically how the market moves. And you now see that Monday, the market does that. So you have people's stops taken out on both sides, okay? But there's let me draw a line here now as well. There is a group of traders who are potentially still in the money. Their stops have not been taken, okay? Because the market hasn't gone to that level yet. And so that group of traders is anyone that maybe short, from this level and are still holding onto those shorts because their stops are above this level. So now that the market has taken out money because it's moved below anyone that may have bought the market, okay, this move down on the Monday, which is a move that takes out the low of the week, is now funding any move in the opposite direction, right? So the market needs to buy from willing sellers, okay? Who are the willing sellers? Well, as I said, people who have bought and they're long, when the market goes above a previous day high, as it's done here, right, then those folks who are long who bought down there, they put their stops here, okay? So they are willing to exit their positions if the market goes back below there, and that's what the market does on Monday, okay? They buy from those folks based on their stops to fund their move higher. Now, why does the market want to go higher from that point on Monday? There has to be a reason, and that reason, as I've said, is these folks, right, who have their stops above that level. They're the folks that have shorted on the Tuesday. They've shorted here on the Thursday, okay? And so now there's a reason for the market on Monday to move up through that level. So I want to see that. I want to see a reason. There needs to be a reason for me to get into this setup that has taken out that weekly low, proven to be a false break because it's back inside of the range. And I want to kind of get in when it pushes back in to that low of the week. Okay, that is then a reversal, and my initial target is going to be just here at these highs, right? Just at these highs. So if we measure that in terms of what sort of a movement is that in terms of pips, which is how we measure currency movement, that there is over 130 pips. So that's a nice move from the low of the week. Trading from the low of the week to the high of the week is all you need to do, right? Now, that move occurs almost weekly on different pairs. You've just got to identify. That's why when I make my videos, I say that when a market goes below a weekly low or above a weekly high, then I get interested in that market. Okay. Now, I'm going to talk about a very easy setup in a moment. That's easier than this to identify. But even that there is very, very easy to find a pair that has broken out from the low of the week and reversed, pushed back in to the range, and now there's a reason for it to move higher because you can see something to the left inside of that week or maybe in the previous week where you can identify there may be what's called liquidity up there for the market to reach for, and it's basically a double top or a single high or something like that. Okay. Now, on this week, we're still talking about this week here. Where is the high of the week? Because that's also a target, right? On this move up, sure, we can see this double top upon which we know there are stops that we know will be rated with this move up, allowing us to exit any of our positions on the buy down low. There's also another target, which is the high of the week, right? The high of the prior week. Okay. So if I go to the left, again, this is the Monday, and that therefore is the high of the week. Okay. So that is also a potential target on the way up. And you can see we've gone through there. Okay. So Monday takes out the low of the week. It's a false break reversal, pushes up, takes out, stops above there. Notice how that on Tuesday, we just dip above that level where we're expecting the market to reach for. Okay. And then we can either exit there or continue to hold because there's a level above, which is the high of the previous week that we also know there's money because we can see on the left there have been people who have shorted that market. Now they may be out. They have shorted the market and they have not been stopped out yet because the market has not reached that level. That is basically the high of that week until this move, which starts from the low of that week, has a reason to move up because you've got this double top upon which there is stops to raid, and you've got this weekly high from the previous week upon which there resides stops. And you can see that on Tuesday, the market raids the first level where stops are on the double top, and then New York pushes up into that high of the previous week. Okay, so now we're at the high of the week. So again, I'm interested in this market. Is this market going to reverse from that previous weekly high? And we can obviously see that it did. Okay, and typically those reversals will come on a Wednesday because Wednesday is kind of the third day. Okay, so this here is Tuesday, right, where it's taken that high of the week, and this here is now Wednesday. So in the current week, we have a high, right? We've just taken out the high of the previous week, right? So this move up on the Tuesday has taken out the previous week's high, okay? But we also have a high for the current week, which has been established on Tuesday. So if I draw a line on Tuesday, that there is basically the high of the week, and the yellow box is the New York session. So this yellow box that's on my chart, that's the New York session. So New York on Tuesday has put in a high. On Wednesday, the market has taken out that high. And what do we see? We see another breakout, right? A breakout above the weekly high, which is proven to be false because we come back down and we're going to push back up into that particular high of the week. Okay, false, break, reversal for the move now to the downside. Now, I didn't trade that. As I said, I didn't trade any of these on pound Aussie. I may have traded something here in the previous week. I'm not sure. Don't recall. You can go and look at the channel. Maybe there's a trade there. They're all posted there on my YouTube community or in the videos, or they're also on the Twitter if I did take any one of those trades. Okay, you can go and look there. Now, we have on Wednesday, which is the midpoint of the week, Monday, Tuesday, Wednesday is kind of the first half of the week. Wednesday is when I like to look for those reversals, and then Wednesday, Thursday, Friday is that second half of the week. Okay, so pound Aussie now broken up, reversed, and pushing up into another week for a false break reversal. So the first thing, if I am going to take this trade, this move above this previous high week, false break, push back up into the high of that week, if I'm going to take that trade, I want a reason, right? I'm always looking for the reason for the market to move in my desired direction. So just like when I've taken this false break reversal from the low of the week and moving up, I need a reason to get in. That reason is, well, there's these stops that need to be rated, and then there's this high of the week that need to be rated. Okay, so on this false break reversal push back up, I need a reason, a clear reason, not just something that is subjective. Okay, that reason for me to warrant a move down is this pump from here on the Tuesday. There are people who have bought into this move and they need to be stopped out. That's a very clearly identifiable pump. Okay, so let me write pump there. Nothing subjective about that. You can clearly see that's a pump up. Okay, and that's my reason for this market to potentially now reverse. My first target is going to be that level where that move started, okay? And you can see we got that on the day, on that Wednesday. Let's have a quick measurement of how many pips that is from the high of the week, and that's 100 pips. I typically am only looking for 50 pips in my trades. So when I'm getting in, I want to measure the potential target and make sure that there's more than, like I want to see at least 75 pips in that potential move down so that I can grab 50 pips. Okay, that's how I trade. So if I'm getting in here on this pushback up, I will measure and I'll say, okay, that's the target. Okay, there's a potential for the market to move 100 pips. I want it to be more than 75 pips. In this case, it is. I'll take it off at 50 pips in most cases, and therefore that's my trade plan. Okay, when I enter these positions, I don't want to see the market move back up against me. Okay, because these are high probability trades. They should move and be green immediately because of price behavior. Okay, remember you're learning about price behavior, okay, how price behaves under certain conditions and what is price reaching for on this move up on the Monday. I've clearly identified what price is reaching for on this move down on the Wednesday. We've clearly identified what price is reaching for. That needs to be very, very clear, not subjective. Okay, now the actual setup that I want to talk to you about when you have a high of the week false break reversal, in that scenario, if you get a market that's just been moving up for 3 days, right, Monday, Tuesday, Wednesday, you get the high of the week and you get this false break reversal. Okay, I'm not saying to trade that. I'm not saying to I'm not saying to trade anything. I'm teaching you about price behavior, price action. When the market closes below its open, so that's the open. We have drawn my square, and this is the close, and it's closed down. So it's closed lower than its open after taking out the high of the week and reversing on a week. Sorry, that's had at least 3 days of rises. I call that the first down day. Okay, let me write that up the top. That's the first down day, and this is what I want to teach you. Okay, in this lesson, we've covered quite a bit in this lesson, but this is the first down day. Okay, and from the high of the week, so all those things. Remember, everything I'm saying has importance. You can't just take one thing and use that on its own. All these things work together. Okay, so that's the first down day after having 3 days of rise taken at the high of the week. It's first down day because we closed down here. Let me grab a square. We closed lower. Right, that's the closing price from our initial opening price. Now, when you have that, I am looking for the market to continue going down, and the idea is to find a sell high opportunity on the next day. So let me open this up a little bit, just so it's a bit easier to see. There we go. That might be a bit easier to see now that we've covered all that previous discussion from the previous week. And I also want to point out that this is that Monday low of the week, right? That started this entire discussion. So let me actually draw a line there because that line is important. That's the current low of the week. And you can see that low has been taken. We'll talk about that in a moment. That's not what we're discussing here. So here's so this is the first down day, okay? Like Wednesday, we've had that false break above the high of the week and reverse, pushing back up into that weekly high. And that's where we've had a close, first time, below the open with a 3 day of rise, taking out the high of the week and coming down, okay? Now, that's the Wednesday. You want to kind of see that on the third day. That's important as well, the day that it happens. It doesn't always have to be that way, but high probability when it's on that third day of the week because that is kind of the middle of the week, okay? You then, on the Thursday, you're looking for a selling high opportunity, okay? And your target is going to be the low of the week, which in this case is on the Monday, okay? And that's typically how it will be. And so any kind of pump up is kind of where you want to be looking for an opportunity to look for the price decline. And timing is important, okay? Timing is very important. And I'm going to give you the times to work with, okay? So you can see that the market, when it opens on Thursday, you get a bit of a pump up here, but that's not really the pump up to expect price decline. Either, in any case, it does in this case. You can see you get another pump up here. This is important. This is one that is high probability for one reason. And that is that the market, notice that the market goes down through the low of the previous day. So that level is important. When the market goes through a level, that specific level, on this situation, we've got this first down day after 3 days of moving up. When you get that pump up will typically come into where that low of the previous day was, okay? And from that's basically, they should act as resistance. From that level, the market should be going down, okay? Based on price behavior, okay? So what you want to see, that. It doesn't have to happen, but the key is that when New York opens, you want to see a pump up. It doesn't matter how small, okay? So in this case, let me open this up a little bit more, okay? Typically, the pump up should be between 45 minutes to an hour. So this is the day that we're talking about, okay? This is the Wednesday, this is the Thursday, this day here is that first down day, okay? And so when I'll make this bigger so that you can see Okay, there we go. There we go. So there's the pump up. Actually, I'll make it a bit smaller because it's not that easy to see. There we go. So here's our first down day. You can see now this is the day we want to get in to take advantage of further price movement to the downside. This here is the pump up that I said into previous day low. Okay, that's important when the market breaks through there. You're kind of expecting that. But the key is that you want to see further decline. And when the New York market opens, which as I said is a yellow box, okay, you want to see a pump up of at least 45 minutes to an hour. Now we can see there is 3 up candles there. Each one of those candles is 15 minutes. You got 1, you got 2, you got 3, and you got this first one from the initial open of New York. So that's an hour of movement going up. Okay, and that timing is important. You want to see that it is between 9 a.m. 9 and 9:30 or 10 a.m. So they're kind of the key times, and that's basically the entry. So that time right there is 9 a.m. that candle there. And what you want to see when you get that pump up, you want to see a engulfment, right, which you see on the next 2 candles. Okay, and so that's our expectation now that the setup has confirmed. Okay, after seeing this first down day. Okay, on that Wednesday. Okay, on Thursday we want to see this move back up, down in New York, 45 minutes to an hour pump up for a continued move down. Now let's talk about targets. Okay, I'll just squash this up a bit again. And so your target's going to be the low of the week from that Monday. Okay, so you're getting in here in New York at the right time after seeing all those things that I've discussed. And you may have to go back and rewind the video and practice this on your own charts, trying to identify this. So from entry there down to the low of the week, again, that's over 100 pips. Okay, now typically, as I said, I'm only looking for 50 pips. So the first thing I'll do is I'll measure. Have I got the potential? Is this from this entry down to the target? Do I have at least 75 pips of potential movement? And yes, we do, because there's over 120 pips. And so therefore, that gives me with high probability the potential to take 50 pips from that move down. Okay, and my stop is going to be very tight. As I said, with these kinds of setups, the market, once you've entered, right, the market should not come back up. Okay, so I will typically put on 15 to 25 pip stop. Okay, because that market, once you get that engulfment, should move rapidly and not come back at all. If the market comes back, then that's not your setup. Okay, that's not what you're looking for. You need to look again. Okay, so we've covered a lot in this video. One thing I want to mention is this trading day here. This is Friday. Okay, this is another very high probability setup and very easy to identify. Notice that on Thursday, where the market has closed, the market's closed here, right? That's the closing price. Now it's closed on Thursday there without taking out this low of the week, and that's important. The market has done that on purpose. Okay, now with high expectation, we expect, I mean, the market should have gone through that on that Thursday, and that was our target from this setup in New York. Okay, and the fact that the market didn't do that is high probability that on the Friday the market will go through that level. Okay, that's another setup that when you see the market has not taken out a weekly low, right? It stopped just before taking out that weekly low on a move down from the high of the week, and it's done that on a Thursday, then you can expect that on Friday it's going to take that weekly low, and you can further see evidence of that with this consolidation. So when you have this type of consolidation, and I typically trade the New York session, okay, notice that again we have a pump up prior to the move down. Okay, now Friday was a heavy news day, so you want to be, if you're not confident in your setups and you don't have experience, well then you don't want to be in that type of environment, because on those heavy news days the market can do anything. But in terms of price behavior, with high probability, news or no news, when the market stops relatively above the low of a previous week, okay, that distance between where Thursday has closed and the low of the week is about 30 pips. Okay, so that's pretty close. So when you see then on Friday you have a consolidation, you typically won't see that size of a consolidation for this kind of a setup. I think this consolidation is predominantly because of the pending news release on the Friday. Okay, so you see this consolidation on that Friday. We know with high probability the market needs to take out the low of the week on the Monday. On the opening of New York, we can see there is a pump up. Again, same rules apply. 45 minutes to an hour pump up. Okay, and if I expand this chart a little bit so you can see that pump up, and there it is there, 3 15-minute candles, 4 15-minute candles going up. Okay, that's an hour of pump up, and then straight through that low of the week. Okay, so on any week where you see that the market has coiled without taking out the low of the week, then you can look for a pump and dump setup. Target wouldn't be all the way down here. It'll just be maybe 25 pips under that particular low. And you're already 30 pips. This range that we measured down to that low of the week was 30 pips. So another 25 gets you your 50 pips. And that's all I'm really looking for on any particular trade. Okay. So just recapping, the lesson here was about the first down day and how to expect and predict price movement once you see the setup. So we've spoken about a lot of the reasons for why the market moved in this manner in the previous week and why this movement occurred to take it the low of the week and why the market then moved back up through, let me grab the arrow, through this, why the market moved up, what was the reason for it, okay? And the key lesson in this video is the first down day. After all of those things that I've discussed, go back and rewind the video, listen to the criteria that I've outlined on what it means to identify a day as a first down day. It's not just that it closed lower. That's not it on its own. It's all those things that I've mentioned. Okay, go back and rewind and listen to the video multiple times. And not only that, go back and look at it on your own charts, on your own computer, so that you can identify. You got to take this picture and put it in your head. And you've got to go back and look at it on different time frames, look at it on different pairs, and really identify this multiple times. Okay, don't just look at this video once and think that you know it. You don't. Okay, you've got to practice this, go back and backtest this, prove that you know you understand it. Okay, now what I was saying is that the last part, what the setup is that when you have all those things, you have this first down day, you're then looking for a sell high opportunity. Okay, a sell high opportunity. A sell high opportunity is some kind of pump up. So any pump up is an opportunity, so long as it is in the right time. And what is the right time? It was in New York at the time that I've mentioned. It can be at 8 a.m. as well, but I prefer for it to be at 9 a.m., 9:30 a.m. or 10 a.m. You want to see that pump up, okay? Or if it starts at 8 a.m., that's good, because then you've got an hour where the market's moving up. 3, 4, 15-minute candles at 9 a.m., you want to see that kind of engulfment start. It might finish at 9:15, you've got an engulfment. As I've shown you in this chart, okay, go back and rewind the video, the engulfment was after those 4 or 3 candles up. And that's basically now a confirmed setup, okay? It doesn't always work, right? But it works with high probability. And, maybe 8 out of 10 times that setup will work. And you note you're wrong if the market goes back up above your entry. If you've entered correctly above that pump up in New York, that 1 hour pump up after that engulfment, the market should never come back up. And your target is always going to be the low of the week. You may not get it on that day, but nevertheless, I'll be out after I've taken my 50 pips. I'm not waiting for the low of the week, okay? But then there's another opportunity on the Friday. Potentially, if the market doesn't take out that low of the week, that's another setup, right? That's a separate setup. Then you see consolidation in New York. You want to see that pump up, and then a setup to take out that low of the week. Okay, so a long video, a lot of things that we've discussed. Discussed how to trade the false break reversal from the low of the week and why. You got to have a why. What's the reason? You need to have a reason for that market to move up. How to identify that? We've discussed these highs and why the market engineers and designs to leave those intact. Okay, every move in the market is a move for the next move, right? There's no randomness. Everything happens for a reason. There's an objective behind every single move, and there's a lot of manipulation, as I've pointed out. And the market's always trying to reach for retail traders' money.